Hello, everyone, and thank you for joining this session. Today, we're going to explore a powerful tool in our financial toolkit, sensitivity analysis. We'll focus on how this technique can help us make smarter, more resilient capital budgeting decisions by effectively integrating risk into our financial planning. By the end of this presentation, you'll have a clear understanding of how to use this method to assess the viability of our future projects. Okay, we'll be moving on to the next slide. Now, before we delve into the specifics of sensitivity analysis, let's quickly ground ourselves in the fundamentals of financial management. A manager's goal is to maximize shareholder wealth. This is achieved through four key functions: making strategic investment decisions, which is our focus today, determining the optimal capital structure to finance our operations, deciding on our dividend policy, and managing our day-to-day working capital. Budgeting, the process of evaluating and selecting long-term investments, is where we can create the most significant value for the company. So, what is sensitivity analysis? In simple terms, it's what if analysis. It allows us to see how a project's profitability, typically measured by its net present value or NPV, changes when we alter one key variable like sales volume or operating costs. This is crucial because it helps us identify the most critical variables that will determine a project's success and understand the potential downside if things don't go as planned. It moves us away from single static forecasts to a more dynamic view of potential outcomes. Let's walk through the quantitative steps. First, we establish a base case, NPV, using our most likely estimates for all variables. Next, we identify the key variables that are most uncertain or could have the biggest impact. Then, for each of these variables, we define a range of possible values. For example, a pessimistic or optimistic and a most likely scenario. We then recalculate the NPV for each of those scenarios, changing only one variable at a time while keeping everything else constant. Finally, we analyze the results. The variables that cause the largest swing in NPV are the ones we need to manage most closely. But not all risk can be captured by numbers. That's where qualitative analysis comes in. We need to brainstorm those non-quantifiable factors that could affect our project. This could be anything from potential changes in government regulations to a competitor's unexpected reaction, or even the risk of our technology becoming obsolete. By developing scenarios around these qualitative factors, we can get a more holistic view of the project's risk profile. Once we've identified the risks, how do we formally incorporate them into our financial models? One common internal method is the risk-adjusted discount rate. For riskier projects, we use a higher discount rate, which in turn lowers the project's NPV, building in a margin of safety. Another method is the certainty equivalent, where we adjust the projected cash flows themselves to reflect the uncertainty and then discount them certain cash flows at risk-free rate. Lastly, we can also take a look to the market for information into a project's potential risk. The capital asset pricing model, or CAPM, helps determine an appropriate discount rate based on the project's market risk. We can also perform a comparative analysis by looking at similar projects undertaken by other companies in our industry. For our international projects, a country risk analysis is essential to account for political and economic instability. By combining these internal and external methods, we can make more robust and defensible capital budgeting decisions. Thank you for your time.